On Friday, we learned the U.S. economy appears to be slowing down. The Labor Department announced 114,000 jobs were added in July. That is well below the 12-month average of 215,000 jobs per month. The unemployment rate rose again for a fourth straight month from 4.1% to 4.3%. This soft report landed with a thud on Wall Street. Investors sold off in droves, with the Dow, S&P, and NASDAQ all losing more than 1.5%. To discuss, we're joined by CBS News business analyst Jill Schlesinger. Jill, good morning.
Good morning.
Economists thought there'd be 185,000 jobs. How surprised are you by this, and what else stood out?
Well, I think it was a surprise miss, but we have been seeing these revisions lower to previous reports. There has been some chatter about the labor market softening. I think what really stood out to me was that unemployment rate that you mentioned in the intro. That rate being up 4 consecutive months is kind of a bad omen. Going back to 1960, when we have consecutive increases in the unemployment rate for 4 months, we see a recession. Okay, don't go crazy. I'm not saying there's going to be a recession, but we do have to at least put it out there. Also, we saw wage growth come down to 3.6% from a year ago. That's still ahead of the inflation rate, but again, it's a big drop from 3.9% in the previous month. So I think taken together, we have to say this is a report that's indicating that there is some tapering off in the labor market. It's not like the, oh my God, DEFCON 4 or 1. I'm not sure which one it is.
I always forget which one
is it. I'm not sure, but it is a warning sign.
Okay.
Well, so this comes 2 days after the Fed took no action on interest rates. Was that a mistake? And what's the next step?
Well, I think the Fed's in the spotlight because I think there are a lot of economists who think that was a mistake. They say, hey, look, you told us that all you needed to see was the inflation rate coming down, and you also wanted to make sure that wage growth was coming down so that consumers were not fueling inflation. Meanwhile, they didn't do anything. But what this does mean is that that September meeting becomes incredibly important because now, while the Fed could cut rates in between meetings, they often don't unless there's an emergency. This could mean that the first rate cut is not 1/4 percentage point, but 1/2 percentage point. And right now, if you look at the markets, the sort of the betting markets in the bond market, they think the Fed will cut rates by 1 full percentage point by the end of the year.
The markets have been riding high for so long, and everybody keeps wondering. Also, the recession, you just mentioned recession. I mean, I feel like we've been talking about this for years now, right?
Yes.
You're here 2 years ago. Is a recession coming? You just mentioned it again. We don't know.
We don't know. However, recessions are part of the normal business cycle. And so what are investors selling stocks for? Because they say, wait, if the economy is softening, if that means that things are deteriorating, if the labor market is turning over, then people aren't going to be able to spend as much money and companies won't earn as much money. Let's sell stocks precisely for that reason, Jeff, that in effect, if you've made so much money in the last 18, 19 months, why not take some money off the table? I will say this about recessions. I know that we hate them, but they're not all the same flavor. You can have shallow recessions, you can have deep recessions. So to be clear, if you're an investor, please don't do anything. Take no action. Stick to your game plan, especially if you're a long-term investor. This is noise.
You can have great recessions, which no one thinks is about to happen right now.
No, absolutely not.
It is an election year. Jill Schlesinger, thank you.